All right, we are live. So welcome. My name is Bronson Hill, and today we are doing the 2022 Multifamily Outlook event. Really excited. We've got some awesome, amazing, just high-level panelists here talking about multifamily investing. They're all very, very successful, have huge portfolios. If you're watching this live, just go ahead and drop in the chat box where you're coming in from. If you're watching this on a replay, we're excited you're here as well. So we'll go ahead and jump right into it. I'm going to do some quick intros, and then we're going to get into the question that everybody's asking is what is happening this year with all the changes, with inflation, with the Fed raising rates. How is that going to impact your multifamily investments? What areas should you invest in? All the questions that you've been wondering. We're going to get into all that stuff in a little bit. So to start out again, my name is Bronson Hill. I am the CEO of Bronson Equity. We do multifamily investing. We also do monthly events like this, and we do other educational events. Joining me today, we have Ken McElroy with MC Companies. Welcome, Ken. We have Rod Khleif with Multifamily Mastery, and Michael Blanc with Nighthawk Equity and the Michael Blanc. So welcome, everybody. Really excited to have you. And we're going to jump in. This is going to be kind of popcorn style. So we'll just kind of jump right into it here. And if you also want to answer that question, you just jump in as well. So I guess the question everybody's asking is, what are some developments happening right now that can affect the multifamily landscape for 2022? Let's start with Ken. So Ken, he'll have you take it from there.
So you mean developments politically, developments at the property level, or construction, or which ones?
Yeah, you can choose which way you want to go with it. Just some things when you look at multifamily investing for this next year, what are some factors you see in motion here?
Well, the biggest one are the policies that we're starting to see, at the city, county, state levels. I think those are making a lot of difference. I was meeting with the head of capital markets from Berkadia 2 weeks ago. He came out for Christmas, and he said that capital is really taking a hard look at where it wants to go based on policies. And he specifically cited St. Paul, Minnesota as one of the markets because they put rent caps in place. He specifically cited Oregon. And he specifically cited Seattle and San Francisco as areas that they're concerned about because of the policies that are happening there. So I think when a lot of times when you're looking at real estate, you oftentimes don't think about whether or not, how capital is looking at real estate. So what I'm starting to see right now is that they're really starting to take a hard look at where do they want to be, and where are they going to put their money, and who are they going to back behind? Because obviously the team, like the guys on this webinar here, are obviously all very qualified, but they're making kind of the same decisions. So I think you're going to see a lot more of that start to pop up, and I think they're very, very, very concerned about what's happening from a vacancy standpoint. Now, this is really generalizing. But he said, I asked him, I said, so when you guys are underwriting, how are you underwriting? He said, well, everything on the coast, and he specifically said West Coast, is basically about 15%. And then everything on the inside is maybe 5 to 6. And then in the Northeast is very high again. And then the Carolinas and Florida are in pretty good shape. So now that's very broad. It's not state or city, obviously in submarket driven, but we were having a very broad conversation. And so the conversations at the private equity, institutional equity level are at the same kinds that we're going to have today here with this group.
Right. Absolutely. Michael, what are some things that you see taking place right now within multifamily, and just some of the factors in play that you think are important?
Well, we've seen the signs of inflation really hit in last year, and we were kind of slow to respond. I don't think we actually caught on until like August, when my partner Garrett, was like, hey guys, you should increase rents by $50, right? And they filled the unit within 2 days, like, why don't we increase another $50? And we're like, holy crap, the market has moved, right? And that's really caught us by as a pleasant surprise on the one hand, right? Or we bought a deal, and by the time our deposit went hard and we had to close on it, we discovered that they were getting 5% of their units were getting rents that we were projecting at 4 years from now. But when the property was listed, of course, 3 months prior, working with 6-month-old data from CoStar, it was priced at whatever it was priced. And so we're like, shoot, we're getting a deal right now. Shoot, we'll pay $1 million more. And so this explained why earlier in the year we were losing, and some other guys were losing deals to institutional investors who are sophisticated. And we're like, why are these guys outbidding us? I mean, they're not dumb. Okay. They're not working with Chinese or whatever, Russian money. What do these guys know that we don't know? Like, I don't, these guys are going hard, $1 million hard. We're doing all this stuff. And then 4 months later, we're like, oh, I see what they're doing. I see what they're doing. So there's this narrow window right now where inflation that you can drive a truck into right now that listing, the listings haven't caught up to yet. It'll close eventually. But that was a pleasant surprise. So, I mean, across our portfolio, our rents are up by 10% in the Southeast. And so that's been a development, and I don't see that changing too much in this new year.
It's amazing with inflation. You're right. It does give a lot of opportunity, but I think it's so important that a lot of investors, and I know all you guys are looking at this as well, but just pay attention to the macroeconomics, right? Because you can't just be a real estate person looking at it only and say, oh my gosh, these valuations are going crazy. Well, 40% of all the currency that exists was printed or created in the last 18 to 24 months. So that dramatically affects, obviously where valuations are going. So Rod, what do you see kind of for 2022? What are some things that you see on the kind of on the horizon here?
Well, like Kenny said, you're definitely starting to see a red state, blue state divide. I didn't realize that the capital people were looking at it as well. I guess, I didn't even think about that. I know operators are. And so, that's a big piece here. But I think we're going to have a record breaking year this year. I mean, we did last year. We saw rent increases of 20% in some places. Like there were half a dozen, actually, I think about 10 markets that went up 20%. So, I think, and what's expected is that is going to, not that level is going to continue, but they're expecting 8% growth. And most of the big players or the big reporting agencies are estimating 8% growth. They're also estimating 95% occupancies. There's I think 1.7 million households being developing in 2022, but they're only delivering 300,000 new units. Okay, so I think it's all going to drive occupancy and drive rents up. So like the Federal Reserve I've got some notes here. Federal Reserve is estimating inflation of 2.2%, but the average inflation is ranging between Moody and Fannie and the Mortgage Bankers Association somewhere between 2 and 4%, but which I think is low. Frankly, I think it's going to be more than that. But the inflation obviously doesn't hurt us. Inflation, is causing these rent increases as well. We were talking before we started recording about, what some of these employers are having to pay to get employees and bonus. And I mentioned Walmart. I saw a sign $15 an hour. Hobby Lobby's paying $18 an hour. You were saying I forgot who the retailer was, or the fast food place offering $1,000 or $1,500 bonus to start. Mike, I forgot who it was, but
donuts, I think.
Yeah. And I mean, this inflation obviously is hitting wages, and I mean, they raised food stamps by, I think, 30 or 40% this last year. Wow. And so, people are I think the stimulus has impacted, people going back to work and stopping a lot of people from going back to work. And I think that, I believe we're going to continue to see rent growth. I think that there's going to be an incredible opportunity in our sector for 2022. I mean, I don't know if it'll rival what happened last year, but I think it's still going to be extraordinary. And I'm the doom and gloom guy. In fact, I did a YouTube video, about the real estate crash of 2021. It's the highest watched YouTube video ever. Of course, I look like an idiot now because it didn't happen, but bad news sells, and I got lots of hate on that, lots of hate comments on that one too, by the way. But the point is, I'm typically negative. I'm typically bearish, but I actually think 2022 is going to kill it. I really do. So.
I'm surprised you're bearish. I know you're like, I call you like the Tony Robbins of multifamily. You're just like always excited, always have something great to say. So what kind of mindset do we need when we go into this year, Rod? What would you say to people?
Well, I tell you, I think, I was just talking to my partner about this today, actually, that, we're just going to be more aggressive than we've been in the past. I think we can be, at least in the short term. Like Mike said, we've had rents increased without us even doing any value add piece. You know, we've had significant rent bumps. We bought an asset, 300 units in San Antonio a few months ago, and we're already eclipsed our first year numbers, and we haven't even started our value add inside the units yet. And we're getting these 8 to 9% rent bumps without doing anything. So, you know, it's extraordinary, frankly.
Yeah. A lot of amazing opportunities out there. I want to just do a real quick poll for everybody of what's your biggest concern right now with multifamily investing. So everybody who's live can go ahead and respond to this. And then when we're done, we'll just go ahead and publish those results. But you mentioned, Rod, that you had some concerns about, the crash of 2021. And Kenny, I know you had shared something about this in the past where you had a 2022 video, at least for single family. Ken, has your view changed on kind of the outlook for 2022 or 2023 going forward, Ken, where it's not so?
Yeah, I think, here's the thing, like we all are kind of reading the same data. And I mean, everyone really is. And it's Yardi, some of the big Globe Street, some of the big services are all pulling from the same thing. So when Rod did his and I did mine, things were very different. I think people need to remember everybody got sent home. Their income stopped. Revenues for businesses stopped. The government said, hey, you don't have to pay rent and you don't have to pay your mortgage. So, so it doesn't take a rocket science to say, okay, well, that's not good. So, so we projected out what we thought would happen. And, now what's really happened is, at the time, if the government wouldn't have put all those stimmy checks in and created all this inflation today that we have now, then I think we if you look back at history, if they allowed it, it would have happened. Now things are very different. Now, what we have is we have people that don't want to work because they've been handed money. I believe in social services. I do. But this has kind of crossed the line, in my opinion. I think, there's a place for people that need a hand when they need it, but this has gone beyond that, I think. And so that's part of the problem that we have. And now we have these rising construction costs and these supply chain issues and all these things. And I have 5 projects under construction in various pre-development and development. And it's problematic. We're seeing 10 to 30% increases on products. So $30-40 million project is $1 million over budget or more, right? 4, 5, 6 million. So those are problems. So yes, from when I started, I think it would have been right. Same with Rod. I know he did a video at the same time, but you got to kind of draw the line in the sand based on the information you have at the time, and that's changed, and it continues to change. And all we can do is try to make educated guesses on whatever the next move might be.
Well, sorry, can I interrupt for just a second? I mean, Kenny, what do you think about 23? Because I don't know that 23 is going to be great. I don't think it is.
I don't either.
Okay.
Everybody, I mean, if you look at, I think that Powell's still hanging on the word transitory, as inflation. You guys know a third of the CPI index is made up of housing, and there's a lag. So all the inflation numbers that we've seen, the 4, 5, 6, 6.8, I think November, if you really look, it hasn't really been calculated in yet. So, there's PPI, which is producer price index, and there's CPI, which is consumer price index, and they mean what they mean. Producer cost, raw goods and materials, that's one thing. That's higher than CPI. So I think, to your point, Rod, we're going to start to see some serious inflation. It's going to get worse. And if the Fed, they went from, we're going to increase rates to now we're going to do it 3 times. I think they came out and said last 2 weeks, that's just going to slow things down. It's just going to make it worse.
Yeah. So that's a really great point. And I wanted to touch on this because those poll results just came back and I shared it under the file setting. So if you see that under file on the tab there, if everybody wants to see it, I was trying to find a way to share it another way. That's how it's shared. But 50% feel that they can't find a deal or they don't want to pay too much, and 22% are that they're concerned about interest rates rising. So I think it's interesting that, we've had a shift. I think a lot of us, and I think if a couple of you guys have mentioned this, where it's shifted from I have a high level of concern to like I need to deploy some assets, right, or deploy cash right away because I don't want to be holding cash. Michael, what would you say as far as kind of that conversation, as far as, okay, I've got money in stocks or I've got money here and there, and obviously we're not giving any specific advice, but as far as allocating to multifamily, are you more bullish or less bullish than you were 6 months ago?
Yeah, I mean, so I'm, I got my butt handed to me in the recession like Rod did and other people. In my case, it was restaurants. So I'm a little more cautious than I was back in 2007. What could possibly go wrong in 2005? Right? Nothing. So, right. So having said all that, I am a little more cautious and enjoying Kenny and Rod in that perspective. Though I think 2022 is going to be an extraordinary year. I can't say anything about 2023. But I think in general, as an investor, okay, you want to be in hard assets. In an inflationary environment, you want to be in hard assets, stuff that have intrinsic value, okay, such as real estate or bullets, okay, or gold, something you can trade, okay, bread, you know what I mean? Something that has intrinsic value, and versus more speculative things, possibly even stocks or, God forbid, Bitcoin, and unfortunately cash as well, because cash is eaten away by inflation, which is really irritating, right? Because we want to keep our powder dry to take advantage of all these opportunities. But man, if an inflation rate is 10%, which I think it's kind of where it is, if you have $100,000, you're losing 10 grand a year. That's $800 a month out the window. Like, imagine this for every 100 grand you have. That's insane to me. So I'm like, oh my gosh, what should I do with my cash? I feel like I need to do something. Should I buy a bunch of gold? Well, gold, lost 5% as well. Like, what should I do? And the only thing I know how to do at this point is to plow it into real estate. Not just any real estate, but recession-proof real estate, which is multifamily, mobile home parks, and self-storage, and stay away from some of those cyclical ones like office and retail and, frankly, even housing. Housing is, I think, a little sensitive, even though I think that's going to do very well in this year as well. So real estate is right now my answer, right? And I need a certain amount of cash because I always need liquidity, which was my biggest mistake in 2008. But man, I'm going to try to minimize as much as I can. So hard assets is kind of where people need to be looking at.
Yeah, and I'll expand on that for a second. If you're looking at different asset classes, those of you watching this, the reason that Michael, I, and Kenny and all of us love multifamily is, if you're in office, for example, your rental amounts, you can't bump them up with inflation in most cases. Same with retail. You're locked into long-term leases, and you can't increase the rents to offset, what's happening inflation-wise, like you can in apartments. And so you can keep, your sustainable, level of rent increases. And so, that's a component of that as well as far as, why we love this particular asset class. And during the crash, people that own shopping centers and office buildings weren't getting help from the federal government. Renters were. Okay. So, that's why it ended up being a blip. I mean, I thought it was going to be 2008 and 2009 all over again, which is why I did that video like Kenny did. I thought we were headed for a meltdown, and I thought that was going to be the catalyst, but it was a blip, and of course they threw trillions of dollars at it, which they had to, and now we're going to have to deal with that piece of it, which is inflation. So yeah.
It has been pretty amazing the last couple of years in multifamily. I mean, it's just been an unbelievable experience. We had a deal in Jacksonville we closed on in March, and we bought it for $27 million, and we're under contract to sell for $37 million just a little bit later. So we bought it well, but just the market and some of these markets are just really going crazy. What would you say, Ken? I'll direct this at you. What would you say? And then other guys can jump in as well. What would you say the risk is? Because everyone thinks about this. If rates rise quickly, or if they rise sharply to combat inflation, could that negatively affect multifamily valuations in the short run or in the long run? If they start raising rates and all of a sudden it just is more to buy, but maybe it slows down the market a little bit. Is that something that you think about as rates rise?
Oh, without a doubt. We're talking about that all the time. Well, I think it's important to just note that, with regard to inflation, demand of anything is the key driver of inflation. So demand of money, demand of rentals, demand of, gold, demand of, whatever it is, so that's always at the moment, especially with these supply chain issues, kind of the key driver. So to answer your question, I think that whenever interest rates go up, then less TVs, less cars, less apartments will be built, all that stuff happens. So, the price of money goes up. So that means your mortgage payment goes up, and that means that things slow down typically. Now, on the other side of that, there's a lot of people chasing yield and trying to get out of cash, and multifamily is something that everybody wants right now. So it's never been this competitive that I've seen. We like you guys, we underwrote hundreds and hundreds of properties last year. We made offers on 87 deals.
Wow.
And we got 3.
Wow.
So those were our numbers, and that was about 1,200 units roughly.
Let me ask you a question, if I may. Do you feel like you may have been too conservative based on what you know now?
Oh yeah. Now you're looking back, and
Right.
you wish you would have pushed for that extra $500,000, $400,000, $1 million, whatever it was, looking back. But at the time, you're trying to make a decision based on pricing, what sales have been in, let's say in the last 90 days, where rent growth is at the time. We didn't have this 10+% rent growth at that time a year ago. And so now it looks like we're going to do it again. So now it's gotten even crazier. I mean, we're like you guys, we're actively probably bidding on 6 to 8 projects at all times. And, we're usually in the best and final somewhere, and usually in second or third almost most of the time. And, but yeah, it's super competitive. You have to come up with hard money day one. I think you have to sharpen your pencil a bit. But for us, the way I look at this is if we can borrow at 2 3/4, let's say, which is what we're at right now, less than 3, and interest rates are, let's say, north of 6. I look at that as free money. Yeah. So I look at that as a way to borrow other people's money, put it in, and get 70% of that from somebody else, and I'm hedging inflation using other people's money. So that's how I see it. And so, but even with that, so does everybody else, I think, because it's interesting times. It's tough, and but I agree with Michael and Rod. I think next year is going to be a banner year, and I mark my words. At the end of this next year, what's going to happen is we're going to have some serious affordability issues, and we're going to have more and more governments are going to step in for rent control. I think they're going to expand Section 8, and the requirements are going to force people into rent caps and all that kind of stuff. So
that's a risk. It's a big risk.
Yeah. I think that's coming.
Yeah.
Do you guys? So that's a really interesting point. So what I heard from that, Ken, was we're getting these, we're getting such low rates. We're basically getting free money to buy this stuff. Then can you really be, let's say you're being aggressive in your underwriting, but inflation is higher than what it's reported, and it's going to continue to be higher. I mean, can you be, more and more aggressive, both as an investor, as an operator, when you're looking at deals? I mean, obviously everybody wants to say, hey, I want to be conservative, but there's a balance between being conservative and getting no deals, and being too aggressive. And all of a sudden, oh gosh, I didn't underwrite it right. So where's that balance?
You got to figure that out. I mean, back in COVID, we were using 0% rent growth in year one, right? And then all of a sudden, inflation kicked in, and we're like, "Crap, 0% first year one is ridiculous." It seemed like a really good idea, because you put 3% in COVID, and your investors are like, "God, you guys are crazy." And then all of a sudden, something happened around August, September, and you're like, "You can't put 0% because if you're too conservative, you never get another deal done." Right. And so where is that balance? And it's a good question. And the thing is, all of us have to figure this out for ourselves. And there is variance there for sure. Right. You're like, well, why would I ever model a 7% rent increase? Like, I've never done that. Like, that's not historical. Okay. But that's what we're seeing right now. Does that mean I need to model a 7% rent increase for the next 5 years? I don't know. It seems a little excessive, right, to me. But is it possibly reasonable for 2023? Would it make, or 2022? Would it make a difference in me justifying another $300,000-$400,000 in purchase price to win a deal? And that's the kind of decisions you need to make.
Yeah. I know there's a lot of people are kind of new to this conversation. We talk about this a lot, and a lot of you guys are researching this all the time and doing videos on this and writing on this. But I want to ask Rod this, because I know you do a lot of education. I know all of you guys are into education, but what are some ways people can educate themselves on inflation, on investing, on the underwriting, and just learning more about this stuff? Obviously your events, but do you have any other suggestions as far as things out there?
I mean, there's lots of incredible resources from the big houses. Marcus and Millichap throw stuff out there. CBRE puts stuff out there. Oh, Kenny, you probably more in tune with this stuff than I am. I mean, what are all the different resources that people have?
It's a great point. I think NMHC
going in 2 weeks right here in Orlando.
The National Association, Apartment Association is a good one. IREM, Institute Real Estate Management, is a good one. A really, really good study, if people want to look at something that's hundreds of pages that I really devour each year, is the ULI report, Urban Land Institute. That's another good study. And by the way, some of them are obviously different than each other. Broker is going to be more slanted toward more optimism.
Secondary gain. Always look for secondary gain.
So, but the good news is like everyone on the call here, I look at all that stuff. We look at all that stuff. Our acquisitions and analysts and, everyone in our company looks at all that stuff, and we're trying to pick the right market generally. And like everyone, is we want to be, we don't want to be a pioneer, but we also want to be there when the market, kind of gravitates with us. We don't want to be a market maker.
Right. And that's a really good point, Ken. Maybe we can just kind of go around the table with this. What parts of the country are you seeing? Obviously, we're seeing growth in the Southeast for migration, but what markets do you like, or what areas do you like? What areas would you avoid? I think those are some things people would be interested to know.
Well, I'll tell you where we are. I live in Scottsdale. I've been here forever. Arizona is certainly one of the markets that's growing. It grew by 98,000 people last year. Texas grew by over 300,000. Florida grew by over 200,000. The North Carolinas grew over by 93,000. So just those four markets are markets that you want to look at. I think you always got to remember that real estate, don't forget, exists for people. Yeah. Period. So, sometimes people forget about that. So if there's no people, like going to a mall, and the mall retailers don't make money, then they can't pay rent to the mall owner, et cetera. So all of that stuff happens organically based on people. So if you pay attention to where people are going, then, and you can try to be in front of that. So we like Houston, we like Dallas, we like Austin, we like and a lot of this is red state related. People are moving there, I think, because of safety and weather and property tax issues and, low crime. They're not defunding police and stuff like that. Now, not to be political, but those are real issues. People are making decisions based on with their wallets. And those are facts. And all you got to do is look at the way moving trucks. You can track your moving trucks with North American Van Lines, U-Haul, Ryder. They all track one ways. You look at the out-of-state driver's license that are being turned into these places. Those are all real facts. Those are people moving, either renting or buying, and then they're creating commerce in those areas, and that's putting positive everything. The sports arenas, the concerts, the restaurants. In Scottsdale, just here, even I've never had to put a reservation in before. Now I have to book stuff a week out. And that's because people are moving here, and so we're constricted. And so that's why we're having the rent growth. We don't have the supply with housing, multifamily, industrial, commercial, office, retail, all that stuff is on fire here because of all the people. So I think it always boils down to that.
It's kind of a perfect storm, because you said the construction costs are so high now. You're dealing with this issue. Therefore, you can't build any more affordable housing. So you have basically a limited housing stock of affordable housing, and you have all these people moving into an area. The rents have to go up.
Yep.
Yeah.
Now on the flip side, markets I would avoid for me would be, you know, well, again, blue states, but Detroit, Baltimore, New York, of course. But you know, those are the ones that are, you know, they're decreasing. I don't know how many people, I had some notes here on how many people moved out of California, but it's like a couple 100,000 last year or more. You know,
I'm hoping to get out soon, Rod. I'm hoping.
Yeah, no, I mean, I'm not. Listen, I love the a lot of things about it, but you know, there's a big exodus, and it's happening from New York down here as well. I was just looking. I know I've got the list, the amount here, but it was kind of blew my mind how many you know people are leaving. So anyway, but you know, like Kenny said, there's some markets that we love. Salt Lake is awesome. You know, Charlotte, like you said, I think Vegas is coming back finally. You know, so they're, you know, and keep in mind that the you know, the millennials, I think, make up 50% of the population now, and they're the, you know, they're spending money, they're buying cars, houses, having babies, and you know, and in many cases they're priced out of the single family house market. Fannie and Freddie just raised their limit that they'll guarantee or insure $1 million single family homes now. For the first time, $1 million single family homes. I mean, that's just astounding to me. I remember when it was like 300 grand. So, you know, and there's, you know, there's such a, you know, unemployment is so low. And in fact, you know, I think there's $10.4 million job openings and 7.7 million people that are unemployed. That's a problem, right? I mean, Elon better get busy with the robotic stuff, because that's a freaking problem. But you know, but those are all things that are going to, you know, an employed workforce that's making decent money, of course, impacts what we're doing. And like Kenny said, you look at a market, you want to see population increasing, you want to see median income increasing, you want to see jobs increasing, you want to see employment diversity. All of those things are critical, and you're seeing that in these cities that Kenny mentioned. And so, you know, that's where you want to be. And if those of you watching, if you want to play around with this, there's some websites you can play around with and look at demographics. One of them is city-data.com, if you want to make a note of that. Another one is bestplaces.net. Another one is datausa.io. Those are all great websites where you can play around with this and look at demographics and see, you know, what's happening in these different markets and submarkets, and make sure these things are increasing. You know, just play with it.
You know, Rod, you can put that in the chat box as well if you
Oh,
want to
okay.
just type
Sure.
those in there, or just put the
Happy
names of them
to.
and people can search them. It'd be great.
Happy to.
But on the other side of that, you know, living in a place like California, it's funny. People are like, why do you live in California? And it's a very long story, but been to Texas 9 times this last year and Florida twice. And all of our stuff is in basically the Southeast or the South. And it's things like you said, population growth, job growth, income growth, business friendly, you know, stuff, less restrictions, people saying, I'm tired of living with COVID. I want to live normal life. And where a lot of you guys live, actually all you guys live, life is kind of back to normal. I mean, in LA, we're still doing COVID everything. I mean, you're masking your dog just about when you go on a walk. I mean, it's pretty crazy. So pretty crazy times. We're going to shift to questions in a couple of minutes here, but I wanted to just leave some space. If there's anything that we haven't covered as far as just what you're seeing as far as multifamily, maybe something that you brought that you wanted to share. Anybody had anything else they wanted to share that you're like, this is really important that we talk about this factor?
I looked something up that was kind of blew my mind, and that is, you know, the average of number of units that have been delivered into, you know, into like what Kenny's building being built. The average for the last 6 years, not last year, but prior to that, was 280,000. Last year was 340,000. And or 385,000 rather, and they're expecting that to increase. But even with that, we're talking about 1.4 million new households. So, you know, it's just going to continue to drive rents up. I mean, and that's why I think even with higher interest rates, we could still see kind of a counterintuitive thing happen. I mean, I could be crazy on this, Kenny. You may think I'm crazy by saying this, but I think there's a possibility we could see higher rates and still see and still see cap rates compress a little bit. Yeah, because of the demand. I mean, it's like, you know, and they're big, you know, a lot of foreign money coming in as well. You know, funds that see, the returns that are being generated here. Kenny, you want to expand on that?
Yeah.
Feel free.
Yeah, I agree. I think the other thing to watch is as the different administrations do different things based on home ownership versus rental.
Mm-hmm.
I think that's important. So if you go way back, because I've been doing this for a while, 20 years plus, when Bush was in office, this is going back, he thought everyone needed to be a homeowner. Mm-hmm. So nothing wrong with that, but that's the opposite of, being a renter, obviously. So then what happened was everybody was buying these houses. As you know, you could fog a mirror and get a loan, and that all crashed in, let's say, call it 08, 07. Mm-hmm. And so that Obama kind of took that on, right or wrong. And then, Trump kind of was dealing with the tail end of that, and now Biden. And so the reason this is important is because as the different administrations push, we got up to 69% home ownership. This is an important number. Every 1% represents a net negative or positive back into the rental market. So we're slowly chipping back down based on affordability and based on government policies and stuff like that. So right now, I think we're around 63.5%. But we were at 68, 67, 66, 65, and it's slowly chipping away. And I think you're going to see more and more pressure fall out of home ownership because of these rising interest rates that Rod was just talking about, and lack of supply. So you can't just add new product. It takes a year. So right.
I just saw a quote. The National Association of Realtors says we are currently experiencing a housing shortage of 6.8 million units.
Yeah.
I mean,
yep.
So again, and you can't, and unless you have government subsidization or some write-offs or grants, affordable housing is very, very difficult to build. And it's not profitable. And so obviously, you're not building any affordable housing, are you?
No, and just to
you have 5 projects going.
That's a 20-year problem.
Right.
For sure. Yeah. There's no way, because you have the existing plus that. So it's not. You still have what's going to happen next year and the year after and year after. So it's a 20-year problem.
Yeah.
And you're going to see very, very aggressive rent growth.
I think it's important that people pay attention to some of the macroeconomic things that we're talking about here. Mm-hmm. But even if you did that, there's going to be a lag. And I saw that like firsthand last year. There's such a lag, like a 6-month lag. You get on, you do your research and you're listening to the news and you're like, oh, this is great. Meanwhile, we discover something else is going on. So I think what's important is 2 things. One, looking at the bigger picture to see where we're going on a macroeconomic level. But you got to, more than anything else, you got to get on the ground and see what's going on right now, because we kind of missed it a little bit last year. We probably could have won at least one other deal if we had paid attention to what was going on with rent increases in on the ground. And so I think it's really important to help you underwrite a deal. And what I mean by that is don't go to CoStar where the data is 6 to 9 months older. Do your comps yourself, which is a lot more freaking work, obviously, but see where the rents are in that area. And it was the gap was unbelievable. And also when this thing reverses, which it will, to see it coming, right? Because everyone's like, oh, we're bullish, we're going higher. And then meanwhile, all of a sudden the vacancy's going up, right? And all of a sudden they're not getting the rents anymore. That's useful information. The only way you'll know that is by getting on the ground yourself. So I think right now, as the market is moving so rapidly, I think you said it earlier, one of you guys, is sharpening your pencil. I think that's how you get deals done right now, is you got to sharpen your pencil. You can't just use data you find on the internet or in CoStar or in freaking Yardi. You got to get your hands dirty a little bit because it's going to give you a competitive advantage.
No, that's really good advice. That's really good advice, guys. Yeah. You have to make the phone calls. You have to do the market studies, your rent studies. That's really good advice.
One option I've thought about as well is if rates rise or when they rise over time, that potentially gets passed down as higher ownership costs to tenants and just kind of leads to higher rents as well. Do you guys think that that's an option as well, that can happen over time? Or do you think in the short run, it's just going to be that, if rates rise and it rises more significantly, then that may not necessarily happen in that fashion? Is that clear what I'm asking?
So what's the question is, what if rates go up?
Well, the question is, if rates go up and do asset prices, if they go up quickly, do asset prices go down? And if they do, or would they stabilize because rents are rising, therefore it trickles down to rents because the cost of ownership has now gone up, as well as inflation is driving rents.
Yeah, let me comment, and I'd like to see what Kenny and Rod think about this. But this was the question you assigned me earlier, so I did a little prep for this. Okay.
All right, this is your moment, Michael.
But December, the Fed already announced that they were going to raise rates by 2 or 3 times this year, and they have to, ease and stop quantitative easing by March, which means that they're going to stop buying $120 billion worth of mortgage-backed security. Okay. All right. Well, that has to happen first before they can raise it. Okay. So let's say they do that, and they're going to raise it by half a point to 3/4 of a point, which is ridiculous because inflation is much higher than that. So the CPI index, Kenny, you mentioned the CPI index, I looked this up, was changed like 8 times since the 1970s in favor of the government, meaning that if you look at it, which I didn't but if you study it, back then the inflation rate was like 13% at the height, I think, or even higher, 30%. If you look at the CPI index, everything was taken out, like food and gas. Oh my gosh, like they're taken out of the CPI index. It's ridiculous. Right. So the report of CPI somewhere between, 5 and 6.8, I think, and whatever we saw. So it's actually higher. If you compare the inflation rate now between in the 1970s, we should probably, depending on talk to, 10 to 15%. Okay. So the Fed is now going to raise interest rates by 3/4 of a point to fight inflation rate of 10 to 15%. That's ludicrous. Like in the 80s, I don't know what it was, but they raised the interest rates to something like 16%.
Oh no, oh buddy, I was there, bud. So, Kenny,
right.
That might even been before your time. No,
okay,
man. If we got 7%, we were doing freaking backflips. Yeah. Okay, so when we hit 7% again.
What I'm saying, to truly fight inflation, they don't have to raise it by 3/4 of a point, maybe. They got to go boom all in, but they got a massive problem. I don't think they'll do it. You know why? Because we have $30 trillion in debt. And if you raise it,
that's right. That's right.
If you raise it by 3% interest, which is ridiculous if they did that, okay, 3% interest, it would make debt service higher than Medicare, Medicaid, and all defense spending. It's ridiculous. Yeah. So I don't think the Fed can actually control inflation at all. So I think the environment we're in is a high inflation, low interest rate environment. I mean, at least for next year. I don't know. I don't have a crystal ball that far in the future. But I don't think the Fed can do anything at all unless they shoot themselves in the foot. Now, inflation is kind of clever because inflation makes our debt become less. So it's better than defaulting, I suppose.
Ken, you want to weigh in?
Well, on which part? I mean, gosh, Michael went all over the map there. I think the theme here is deals are really hard to find. You have to. I believe they're going to be covered by rent. I believe that we're going to see massive rent growth. I also don't think I don't think the Fed can raise rates. That's my belief. They first said they were going to do it last year, and then they didn't. I guess the tail end of this year. They said they were going to stop buying bonds last year, which it's 4 days ago. So, but they didn't, and now they're bumping it down the road. I think they said they were going to start with 30, drop by 30, and it was going to be at 90. So they're kind of all over the map, and I just don't see the rate hikes like like they're saying. And if they do, it doesn't matter to us. It's a quarter point. Yeah. So it goes from 2.75 to 3, or to Michael's point, 3 to 3.25. Who cares? We're still 3%, 4% under inflation. It won't make it to the renter. I will tell you that. And if you look at history, when the Feds raised rates, real estate buying has slowed down. But to Rod's point, there's so much capital chasing yield. It might not. It might not. I mean, people might just be, it might be, like trying to buy a used car right now. It's, you have these crazy people are trying to get out of cash. They're trying to get out of other assets. And, it's still low.
Yeah. So what we're talking about, oh, sorry, Michael, go ahead.
No, I was going to say, what could happen then is, we're expecting a 15% IRR, as investors are expecting, 13 to 15% IRR. But you're right, versus a cash or a stock market or anything like that, that inflation is going to eat up. I wonder if investors would accept something like 10% or 9% IRR, right? But the question is, what happens if the profit margin starts to be squeezed? What happens to us at this point? Do we now need to look at some other asset class, or are investors going to go with us on the ride? Right? I don't know.
So I think that's what's happening to other asset classes. That's why we're having so much capital into the apartment market. If you look at the capital markets, let's say pre-COVID, you had retail, industrial, commercial office, multifamily, residential, and there's more, and capital kind of takes a look. Okay, I'm a little here, a little there, a little here, a little there. Well, there's not money going to malls. There's not really a lot of money going into the commercial office. There's not a lot of money going into retail. And, and there's some, so that capital is looking for other markets. Blackstone has made an offer for us. So they tried to buy us. They're trying to buy companies. They're trying to buy residential companies. They're trying to buy companies like ours that own assets now to get into the space. That's where the money's headed. And it's to Rod's point, these interest rate hikes might not affect multifamily much next year.
Well, but there are other things that are still dangerous. I mean, they were talking about messing with the 1031 exchange. I think that's off the table now, but I mean, that would be devastating. They've got to pay for all these trillions that they're, we won't get political, but thank God that bill didn't pass, in my opinion, that latest one. I mean, you got this money's got to come from somewhere. And so, I like I said, it's off the table now. They've lobbied it away, thank God. But it's still kind of there, hanging out there. They're going to have to pay for this stuff somehow.
Yeah. I wonder with inflation if there's a point, maybe not this year or next year, but at some point it gets so out of hand where it's you're doing these very minimal rate increases and inflation is obviously at 20+% or higher because we have no fiscal restraint anymore, and it just gets to be out of control. So I want to take a quick pause here. We are going to go into questions here in a second. I also wanted to make an announcement. We are doing an event next month. So we do multifamily events like this once a month, and we do events on inflation. So we have one on February 2nd. I'll put it in the chat box. And it is actually looks like I put it in the Q&A section, but it's going to be George Gammon, Rick Rule, who's a precious metals guy, and a guy named Mark Moss. So talking about inflation. So I will make sure that is in both the Q&A and the chat. And then we're going to take some questions here because we've got a bunch of questions and we've got you guys for a few more minutes. I want to make sure that everybody can hear or have a chance to ask a question. So if you have a question, just put it in the question box there. So this is a really good question. Let's talk a little bit about rent control. Do you think it will just be a red state issue, or is it a blue state issue? I mean, is it both? I'm sorry, is it only a blue state issue, or is it going to be a red state issue also?
That's a very good question. Who knows? Kenny, you got any thoughts on that?
Well, I met with our governor in Arizona. I happened to know him before he was governor. He started Cold Stone Creamery, and I was in a group called YPO with him, and so we met, and he asked me this question, and so it's on his mind, and I think they're concerned about homelessness. I think a lot of the governors are concerned about displacing people and where they're going to go and affordability and all that kind of stuff. So I don't think it's a red-blue issue. I think they're looking at their people that live in their state, their affordability issues, and I think that hopefully we can come up with some creative things. One of the things that we tried to do was when I sat down with Doug is I said, listen, you need to relax some of the zoning and you need to relax some of the parking requirements. And then these might not sound like big things, but they are, because if you take a 10-acre piece of land and you can only build on 7 of it, it makes a difference versus first being able to build on, let's say, 9 of it. So, all those little things in LA County, which is where you are, they just increased the density by 2, the zoning. Yeah. If you had an acre, you build 1 house, you can build 2 now. That helps. Those are little things the government can do. And so it's not a blue-red thing, I don't think. I think it's a people thing, and it's a real thing. It's they're going to be in trouble. This is not good. This is not, as a landlord, I'm telling you, this is not good for the renter.
Right. What are some of the biggest mistakes or risks that you're seeing seasoned investors make that's going to kind of bite them in this time? Like, what are some mistakes you're seeing people make? Maybe Michael or Rod, do you guys have any thoughts on that one?
Oh, well, I used to think they were being too aggressive. We'd be investing final, like, how the hell are they paying that much for this asset? Now I'm like, oops, maybe we should have re-looked at that. But, there are tons of mistakes that happen in this business, being undercapitalized, not figuring out where your capital is going to come from, and you put a place under contract. And we've gotten great deals that people weren't able to, raise the money on, being cursory with your due diligence and missing important things. And, there's so many places that people, Michael, feel free to tag on.
Those are all great things. And, the good news is that this kind of environment, solves a lot of, sins and issues that people have. Right. And it makes everyone look like a freaking genius. I think the one area that has been affected by COVID more than anything else has been in the construction part of it, Kenny, as you well know. But when you're doing heavy value add and you're trying to turn 10 units a month because you're trying to get the 150 units and no one's willing to show up for work, and you can't get the lumber, you can't get the appliances, and now all of a sudden you're behind on your NOI predictions. That's been probably the biggest issue. And I don't know if that's a mistake per se. It was very difficult to forecast that and even mitigate that. Though, having said that, now, we underwrite our construction costs significantly higher than we did before. We're like, oh yeah, we'll put $6,000 in every unit. We're like, I don't think so. We better put in 15 because I don't know where this is going to go. Right. And so we're changing underwriting to be more responsive. So, and it's not necessarily a mistake per se. It's just the market has moved so quickly that it's been hard to adapt. But I think that's back to what I was saying earlier. We got to really stay in touch with what's going on. And according to construction, typically you just outsource your construction to your property manager or your GC, right? Your general manager. Well, you don't really know what's going on. All of a sudden they're behind. Well, why are they behind? Well, because no one's showing up for work, or I can't get appliances. So it's your business to figure out what exactly is going on so you can be more proactive about it.
So let's talk for a minute about a change that's happening now. This question is about cost segregation or accelerated depreciation. There's some phasing out of this expected to happen over the next several years to 5 years. Do you think that will somehow be extended? Obviously, people invest in a lot of these, multifamily syndicated type of deals that we do because of some of the tax benefits. Do you think that will go away? Do you think it's just do you think that Congress will change that? Or do you guys have any opinions on kind of where things stand? Because I think at the end of this year, or is it the end of next year, it starts to phase out. I can't remember if it's the end of this year or the end of next year.
I wouldn't have a clue.
Here's the thing. Even if it were to go away, okay, it got there. It was already awesome to begin with, and then with Trump, it got even freaking more awesome. So the only thing that's going to happen is going to go back to awesome. And
there's a bunch.
You just went political there, Michael. No, I'm just kidding.
I'm just saying it's like, okay, I don't know. I don't think it's going to make a big impact.
We could wear these hats that say "Make syndications great again." We could go around with those. So
it's not political. You just see what's going on.
I'm just playing like you were saying. Trump's coming back. I was just messing with you.
Okay. Well, whatever. Doesn't matter to me either way.
We're not being political. We're just joking around. But Kenny, were you going to say something?
Well, I think every single time the administration comes in, they have a whole bunch of things that buzzwords, carried interest is one, 1031's one, capital gains one, cost seg's one, bonus depreciation's one. All that stuff always seems to be discussed. It just kind of depends on, what's going to stick. I think that, you got to think of the government. One of the government's biggest problems right now is housing, period. And they can't do it themselves. They have to rely on the private sector. So I believe that if they start to put more impediments in our way through these kinds of things, yes, it might fund something else, but what it'll do is it'll slow down investment. It'll slow down money going into that sector. And they need us, like it or not. They need us. Rod said it perfectly. There's 6.8 million. We're 6.8 million housing units behind right now, period. That's facts. That's math. So you know, the more stuff that they do, it's just going to slow it down. And what they really need is to figure out a way to speed it up through tax credits or Section 8 or giving us more money or relaxing zoning or something, because what they need is supply.
Yeah. And they need, you know, reasonably priced supply as well,
Right.
you know? So that's a really good point. They'd be shooting themselves in the foot. Of course, they do that all the time. So who
They
knows?
do. Yeah. That doesn't mean that it's rational, but
Right.
If you have another question, go ahead and drop it in the chat. We're going to wrap here in a minute if we don't get more questions. We've got these three amazing operators here to answer your questions. So we'll maybe take another question or two. Wanted to go around before we get to the last question or two. Just maybe each of you can share anything that you're working on, any sort of giveaway that you have as far as anything, any way people can kind of follow you guys if they don't know. If you don't know each of these individuals, these are, I would say, you know, some of the top syndicators, you know, huge portfolios doing amazing stuff. So if you don't follow them, you're not on their deals list, you're not in touch with them, you need to be. So let's start with Rod. How can people reach out or at least connect with something?
No, I appreciate it. So, you know, Michael and all three of us are actually educators as well. And so, you know, I just had 800 people at a live event in Orlando a few weeks ago. And I actually have a virtual event coming up March 13th and 14th. And I've got a holiday special, and I just texted my team. I said, give me that landing page because it expired, but I've got a hell of a deal if you guys want to come. It's $97 for 2 days of training. I don't sell anything there. It's just full on training for $97. And it includes, I just did a new course on courage and confidence. Because if you ever listen to me, you know, I believe 80 to 90% of your success in anything is your mindset and your psychology. So you get that course for free. I've got a finding deals course. You get that for free. You get the recordings of the event for free. I mean, it's like a duh. So if you're interested in the business, hang on. There's the link in the chat. It's a little long because again, it's expired right now, but it's rodkhleif.com/checkouts/holiday. But it's $97 to come spend 2 days with me. I don't sell anything there. It's 18 hours of freaking training and it's full on. So, you know, it's kind of a no brainer. Plus you get all those incredible bonuses. So, you know, again, if you're interested in this business at all, come join me. You'll be glad you did.
Awesome. Thanks, Rod. Really appreciate you being here today. Kenny, what about you?
Mine's simple. Just go onto YouTube and watch our lives on Mondays at 11. You know, and then I usually try to pick a topic every week that I feel like is like this, you know, something, and we do deep dives on it. I bring some. I have two guys that work with me. One's an attorney and one's a CPA to talk about like a lot of stuff. You know, it's free. So you just go on there. KenMcElroy.com is a good spot to go. And of course our podcast and all that. So we have all those things. But I would just start there and, you know, just subscribe to that and watch that and then take it wherever you want to take it.
Awesome, Ken. Thanks. I love the Be Infinite t-shirt as well. So I'm sure you're selling those on your site as well. So I love it. Michael, how can people follow you, what you're doing?
We just consolidated all of our free resources in what we call the Freedom Vault. It's at themichaelblank.com/vault. And basically there's a bunch of stuff in there that we put out over the years all in one place. And one of them is a complete guide to passive real estate syndication. So if you're interested in finding out more about what it's like to invest in a passive deal like Bronson's talking about, or Kenny and Rod, and this would be a great resource for you. And there's other things as well, and how to raise money and find deals and depending on what you want. So they're all in one place. It's themichaelblank.com/vault.
Awesome. Thanks so much, Michael. Really appreciate you being here as well. Just want to say as well, we're going to take another question or two, but these events, we're doing these once a month. So if you have input as far as who you'd like to see at one of these events, either multifamily or about inflation, kind of macroeconomics, shoot me an email, bronson@bronsonequity.com. This is a free report that I have. It's the single best investing strategy during and after a pandemic. Talks about all the benefits of multifamily, particularly during times of pandemic. I'll put the link in the chat there if you didn't have it. If you don't have it, you can check that out. So the question here I thought was really interesting is if someone wants to be where you're at, how would you say to get started? So being an operator in multifamily syndication, what's step number one?
Get educated.
Yeah.
I mean, Kenny's stuff is fantastic. Michael's stuff is fantastic. My stuff doesn't suck. So get educated, okay? That's the number one thing. Competence first. That'll equate to confidence. Then you'll have the ability to influence people. But that's the flow. The knowledge and competence is first. So just get educated. Go to watch Kenny's stuff, watch Michael's stuff, come watch my stuff, and go kick butt. That's it.
It's great. You guys have any other thoughts?
That's
Well, you
good
don't
stuff.
want to know what's going on in here. That could be a problem.
You mean it's infinitely bouncing around right in your head? You got these.
I don't know, man. Like I've gotten the hell beat out of me over a long period of time, but I think that the wisdom that I have is that I think a lot of times people go out and they think real estate is like a transaction, like a stock. Don't be duped into that. There's a whole team and education around the finding of the deal and the managing of the deal and the reporting the investor, and all that stuff is really, 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 really important. So plug yourself into somebody first that knows how to do it. And learn as a mentor, and then go out and do it. You don't want to use your money or somebody else's money, because even at our level of experience we've had, I'm speaking personally. I've lost people's money, and this is not a faint of heart thing. This is something that you really have to take seriously. It's real people's money. Got to be really careful with it and treat it just like it's your own.
Yeah, I think people should just be open-minded about their investments, right? People are watching this right now. They tend to invest in stock markets, ETFs, and God forbid, Bitcoin. Okay. I would say, educate yourself around alternative investments in general. What are precious metals for? What are they good for? Why should you invest in oil? Why should you invest in multifamily syndications? And then simply just get started. Take a small portion of whatever your portfolio is, and invest with Kenny, invest with Rod, invest with me, and just see how it goes. And what'll inevitably happen, you'll see the check come in. You're like, oh, this is pretty cool, and you'll see the tax benefits of that and the cash flow. And you're like, my gosh, why am I even investing in the stock market? Which is a great question. But, we're not going to sit here and tell you to pull all your money out of your stock market. But I think you should get started in a small way, because it is truly the best investment on the planet.
Absolutely. Well, I want to be sensitive to everybody's time. I just wanted to say, each of you, our panelists, just thank you so much for being here. You guys are titans of our industry, and to be able to have a conversation around this with each of you has been awesome, both on a personal level, as well as I know everybody watching this has gotten a lot out of it as well. So also, if you're watching this, and just wanted to say thank you to you as well for joining this event. The best investment that you can make is really in your own education. So you did that today. So well done. 2022 is just small little decisions like that. So well done for educating yourself. I hope you do take that first step in looking at that deal, investing in that deal, checking out that market, calling that broker, whatever that next step is for you. I hope you do it. So anyway, thank you again for our panelists for coming. This was awesome. I hope you guys have a great January. Happy 2022 to everyone. We look forward to seeing everybody at the next event, or just down the road, maybe some other event. So thanks so much, everybody.
Nice to see everybody.
Good to see you guys. Yeah,
Nice
it's a lot of fun.
Okay. Thanks, guys.
Take care.